So many business owners, they get tunnel visioned about their company that they're building, their business, and it provides their family all the income that they're going to have. It's probably the largest wealth asset that they're going to have.
Your business is the best accelerator to your wealth. You need to build everything to sell it. Begin with the end in mind.
I've done that before and I've had good successes. I've done that before and I've had lawsuit and had to sue my partner for getting my money back out. I mean, it's the full gamut. It's not that they don't have enough cash on hand, it's that they have too much cash on hand.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Hi, and welcome to the Business Coach. I'm your host, David Finkel. And this week, I think we have something really special for you. I'm joined by former coaching client, Mark Watson. Mark is a serial entrepreneur who's built multiple successful companies. He's sold some, he still owns some operating businesses, but at the same time, he's built a mini real estate empire in the southeast part of the United States. And the reason for this subject is, as you as a business owner progress, how can you intelligently build wealth outside of the operating company or companies that you're building? We're going to get into why that matters. And most importantly, Mark and I are going to give two different versions, including sharing our own asset allocation for how we invest our wealth outside of our operating companies. For me, the Maui businesses that I do, the business coaching companies and training companies, and for Mark, his operating companies in real estate brokerage and the gyms he used to have that he sold, and the property management companies that he has, the storage that he has. And we're going to talk about it separately. Mark tends to be a bit heavier on real estate than I am, although we both have it as a component. And we both have learned to ask the question, well, gosh, how can we make sure that our families are protected even if something happens to us and that we no longer have the capability or even are around to manage our own portfolio outside of our active businesses? And the net result of all of this is I want to put you on a pathway to start effectively thinking about now, how can you either grow or accelerate the growth if you've already started for your wealth independent outside of your active operating businesses. Without further ado, here is that conversation between myself and Mark Watson. Well, Mark, welcome back to the Business Coach. How are you today?
Doing really well. Excited to be here today and excited for our conversation.
Oh, I am too. So today we're going to have a lot of fun talking about investing outside your active business. But I think the place I just want to start here is, I know your kids are involved with different sports and so forth, but one of the things I always thought was really quite cool, that you've kind of become the de facto home for a group of I don't know if they're late teens, early 20 people around the church group that you're part of, wherein they just kind of make your home their home. I'm just curious, over the last week or so, did you have any guests coming and hungry people feeding and anything like that? I always found that inspiring that you and Kay have opened up your home for this little community in a way that it just feeds you in a good way.
Yeah, so we're in a small town in Arkansas, about 30,000 people, and there's a university here. It's a small Christian school, about 5,000 or 6,000 students.
Yeah.
And they come from all 50 states and 50 foreign countries. So it's a super diverse student body. But for most of those people, they don't have a home anywhere near here. And so for the last few years, we've done a college Bible study at our house on Wednesday nights. Oftentimes that'll include food. We may have 20, 30, 40 college students show up and just spend about an hour in the Word and prayer and just talking about life. And so, and every time there'll be 4 or 5 or 6 of those that we really connect to. And next thing you know, they're babysitting for us, or they're dog sitting, or maybe house watching while we're gone. And so we have this unique ability, or because of where we're set, we'll have this 2 or 3 year window with some of these folks that are just passing through, that we can be a staple for. We can be a place that they can count on us. And it's also great for our kids to have some of these older college students to look up to and to learn from. So it's super rewarding, but I'd be lying if I didn't say we were getting a lot out of it too.
I love it. My friend Steve will go for hikes with some of these young adults, and that's where he does some of his best mentoring. And for me, I tend to do it more around events that we're hosting. A lot of times it's the adult children of coaching clients, and to see these people blossom and bloom that way it really is rewarding. Today, we're going to talk about something outside of business, which I think is really important, but it will tie back into the business they do, which is, Mark, I want to talk today about this idea of investing outside of our active businesses. So as a business owner, conceptually, the way to think about this is, so many business owners, they get tunnel visioned about their company that they're building, their business, and it provides their family all the income that they're going to have. It's probably the largest wealth asset that they're going to have. It's going up in value. Next, let's say 5 years ago was maybe making 300,000 a profit. Now here you are 5 years later, it's making 2.5 million in profit. So the valuation went from a company that was worth $700,000, $800,000 in value, that today maybe it legitimately is worth 12 or 14 million dollars or more. So from a wealth perspective, no better engine. But I have had so many observations with the clients we've worked with for 20 plus years, wherein when they've sold their company, it's the view from the other side, like what have they done along the way to build wealth outside the business, to learn the skill sets of how to do that, to build the wealth such that their risk in the business is different because they're already independent outside the business. So I thought we just would talk about it. And so the place I want to start with is selling a company. So you've done this before, for example, with your gyms, and you've sold that business before. I'm curious, when you go back right from the very beginning, you come from a different background than a lot of our coaching clients, wherein you came from a background that was an investment finance background, where you worked as an executive at a real estate investment trust, at a REIT. So you came at it from a frame as an investor, but you've also seen a lot of business people that probably don't realize that their business is in fact a financial asset. I'm curious what you've observed, whether it be in Circe or at one of the conferences you've been at beyond there, where business owners sometimes miss that their company is in fact a very valuable financial asset in addition to the actual income that it generates each month, each quarter, each year.
Yeah, I think one of the concepts we learned early on as part of the Maui, being a coaching client, was that concept of your business is the best accelerator to your wealth. And so I've kind of looked at it and thought about our operating businesses that we've owned and operated over the years. For me, those were the short term. I would call it kind of the short term engine. It would spin off cash flow from operations, and we would take that excess income and put it into real estate. And that was more of the long-term part of our engine. And so for years, that's really been my focus, is thinking through, how do I create passive residual income streams, mostly derived from real estate. I know that conceptually, you can also do that with an operating business, but for us, it's primarily been in the form of real estate assets. And so I think what I've observed with other business owners is they get so focused on their operating business that they don't see that as being the accelerator that it is. And they also don't know what to do if they were to sell that business, and how they'll continue to have an income stream in the future if it no longer exists. And so there's a lot of either fear or anxiety or feeling stuck sometimes in your business, not knowing, well, if I sold it, well, I guess I'll have to go get a job. I've got a good friend who's not part of the Maui coaching community, and he has a phenomenal business, 10 or 100-fold the size of our business, and he's considering selling it right now. And he's saying, I'm not sure how I'll have income afterwards. And I'm like, you could put it in a muni bond and have enough income. And so there's just that concept of like, what do you begin to do outside of your business to invest and to create wealth and passive income streams, separate from your active, maybe daily focus in your business. And for us, that I feel like there's always been a tether of that, which has been good for us in creating residual income streams through real estate that are a lot easier to manage one day than maybe an active business with lots of employees. But it is an interesting thing to see folks that are out there, in many cases, performing exceptionally well in their business, but the concept of investing outside the business and the power of it escapes them.
As you say that, the reason why I wanted this subject here is because I'm going to use the two of us at kind of a different track along the way. So what I observed for you is you've done your operating businesses both to provide current income and to spin off excess cash to invest long term in the real estate projects for you long term, which is an absolutely viable, smart way of going if it fits a certain set of advantages. I've approached it differently than that. I'm building my operating businesses to scale those businesses, and the investing I'm doing is a side thing.
Yeah.
Whereas for you, the operating businesses to generate for the real estate, your real estate is really the main thing with that. Both are good strategies, but they're two different ones. And by bifurcating the two of them, I think our audience can pick up some good stuff. So for Mark, let's start with you here. When you looked at active businesses, what was the horizon that you saw that these businesses you were going to want to own? And you could probably make the distinction between your real estate-based ancillary businesses from your real estate brokerage company, your property management company, versus the ones that truly are really not so connected to the real estate. I guess actually even that, your gyms were connected to the real estate because you own the real estate. Darn it, they all keep coming back to the real estate. But I'm curious for you, when you thought about duration, what's the way that you thought about the duration of those operating businesses as opposed to the underlying real estate?
I think, David, early on, it's not that it wasn't something I gave much thought to. It probably was just outside of the realm of the way I thought about the future, in that I always wanted, I mean, one of the things I learned from an institutional investing background with working for a REIT was that you need to build everything to sell it, begin with the end in mind. And so even in our early days of operating businesses, our financials were in order. Everything was about as clear as it could be so that if we needed to sell, it's super transparent. The value that we arrive at should be very obvious. The potential liabilities from missing information is not there. And so it would help us to sell that business and to make it more marketable. But I was always thinking about stacking passive residual income streams. And so the thought was, why would I ever sell anything? I almost just assumed they would all go on in perpetuity, because if they started to go away, well, then now that income stream's gone. And that's the whole reason why we did this thing. And so early in my career, I was very focused on just obtaining and growing assets as much as possible, and then trying to create them more and more passive through hiring leadership into them or putting systems and structure in place. So it required less of me in the daily operations. And it wasn't really until the last 2 or 3 years that I've really thought about what's it look like to sell these assets and put them into a place where they still generate income outside of my quote unquote business, because I just thought everything will just go on forever. And that doesn't make sense, because there's times and places where it makes sense to harvest and to
when you think about your businesses, though, Mark, I want to interrupt for a second here, which is today, when you look at where you create the most economic value, you, Mark, your role as the owner of these various businesses, where do you see your highest economic use for the various businesses or assets that you have? I'm curious.
asset allocation.
Okay.
So there's our businesses have spun off cash over the years, and a lot of that cash was just piling up in an account. And people always said I was an investor in businesses and an investor in real estate, and I even would say that. But the fact was, I wasn't really an investor. It was more of a creator. We would take something and create profitability and assets and businesses out of something that didn't exist before.
Yeah.
And so the cash flow was a byproduct of that. But that cash flow wasn't necessarily being redirected back into investments. It was just sitting in a bank account earning nothing. And so one of the things I've spent the last 2 or 3 years thinking about is how do I continue to grow, and to think about what it looks like to be a prudent investor. What does it look like and mean to invest where you have advantages and just buy the market where you don't have advantages? And so I don't know if that answered your question exactly.
It does. And I'm going to restate what you said here for our audience, because inside of there's like 3 lessons I'll put out there. So first of all, the question of what is my highest economic use for my companies or for my financial life is a question. It's 2 separate questions, right? In the business, what's my highest economic use? And outside the business, for my family's wealth, what's the highest economic use? And you're really clear on that. For you, you use the term asset allocation, which is the choice of what to invest in strategically, what not to invest in, even more importantly, where to invest in it. So I know you've done a lot more of your real estate has been more quality triple net lease stuff, and or self-storage is a big area that you put a lot of energy in. The decisions on that, and then the micro decision of which sub-markets you want to either buy or build storage facilities in, has been a big one for you. So that question, in my business, what's my highest economic use, and in my financial life, like for me in the business, by far, my highest economic uses are three things. Number one, the strategic decisions of the company in the big way. Number two, leading my leadership team to stay focused on those strategic decisions. And number three, actually the promotional value of what I do for the company as a de facto spokesperson. This podcast, writing other books, that's a place where I bring in a lot of attention for the business. But from a financial perspective, it's interesting because most of my investing outside of the business, I'm not the direct active partner in it. I'm a passive partner in it. Even my real estate today, I just don't, I have one direct rental. The rest of my commercial real estate, I'm a money investor in other projects. To our Business Coach podcast listeners and viewers, I wanted to just for a moment here pause and tell you about a brand new tool that we've taken about 1.5 years to create. It's called the Ultimate Business Owner's Toolkit. And in there, you'll find 6 of the best, most popular tools that we've created for use with our business coaching clients to help you scale your company, to make it more profitable, and quite frankly, to make it more of a joy to own. All the tools are right there with really short and simple 5 to 10 minute introductory teaching videos that show you exactly how to use those tools to get them producing for you and for your company today. So for information about more of that, you can see the show notes, or you can go to MauiMastermind.com and go to the resources section and get your copy of that toolkit and get access to that now. With that said, let's get back into the podcast. By far, the highest economic decision I can make, or I contribute, is growing my operating business, because forget the cash flow. From a valuation standpoint, there's no outside investment that I could passively do that's going to give me the same growth rate compounded as that operating business the way I'm currently doing it. You, on the other hand, are doing your investing in a more active way, and you've cultivated these advantages to do it really well. So those would be the 3 points. I'm going to go back and just say what they are, because they were inside of what you said that were really good. The questions: what's the highest economic use for me in my operating businesses and for my wealth in general? I'm going to ask you for what's the highest economic use for you in your operating real estate companies again in a moment. Number 2 was, when I do that, the second place for me to look at is, how am I tracking with that? Am I really giving the best of my attention to those things that make the biggest difference? And then the third kind of hidden lesson with what you were saying there for you, which I really appreciated, when you started to build the operating companies, you built them from the very start, that the financial systems and the non-financial systems, the staff, even just collecting of the files and information, were such that you would reduce anxiety of a buyer, so there would be more transparency, which makes your valuation much higher because you're doing things in a professionalized manner. What did you say was your highest economic use for your operating your real estate companies now? And I know you said it for the real estate itself, but go back to like your brokerage company. Well, I know you're more of a passive partner with that, or go back to, the property management company that you have. Again, I know you're a passive partner with that, but what's your highest economic use there besides just smiling and saying attaboy to your partners?
Yeah, definitely. So I sit in the visionary seat in our business. So that would be the areas of value that I'm responsible for is setting the tone for our culture. Number 1. Number 2 is creative thinking, new ideas. Number 3 would be new opportunities or acquisitions. So for us doing a project, we create a lot more value in buying an empty building and converting it to a climate control storage project, and then building drive-up storage in the outlot or in the parking lot, than we do to go just buy an existing storage facility. So all of our projects that we have are more of a value add approach. And so I create the most value by going and finding and putting together and negotiating the next project. It was funny, I was talking with my team this morning in our quarterly planning session, and just saying that 2 quarters ago, one of the things that we said would be successful is that 50% of my working time was allocated towards new investment opportunities or new project opportunities. And we sit here today, 2 quarters removed from that, and I don't think it's getting 5%. Like, we're not moving the needle in that place, and we all agree that that's where I'm best suited and where I create and unlock the most value. So we've got to take some of the things that are bottlenecking me from being able to do that and spend more time there, because it's most certainly where the most value comes from.
The fact that you've identified that's fantastic. You know, your morning awareness of, oh, it's only 5%, let alone 50%.
Yeah.
What's interesting though is you've done extraordinarily well with just 5%. Imagine if you didn't hit 50, you just doubled it to 10, from 5 to 10%. It's still going to move the needle. And if you could get to 20% gulp, as someone who once upon a time has given some coaching advice to you, I'm going to give you one right now because I can't help it. I can't stop myself, which is, let's not jump from 5 to 50%. Let's not 10x it. How do we get you to 10% this next 90 days, and then from 10% to 20%? Because I'm going to laugh. At 20%, you're going to be so flooded with new opportunities coming in for you. You're going to have to cry a little bit of uncle. There's going to be so much flooding in there with you, because that's 4 times the current amount. And that's how efficient you are. I know it. That's how efficient you are.
Well, that's good. That's good to hear, David. And you're right. That's one of the things we talked about, is what's a leading indicator that'll help move us in that direction.
Yeah.
And one of the things we came up with was market visits. If
Right,
we
driving
know the
around and
markets we
visiting in a
want to
market
be
space.
in, like, I just need to go to the market and spend a day or two there.
Yeah.
And the activities we'll do in that day or two, we'll flip over rocks and we'll unearth opportunities. And next thing you know, we'll be getting financing to go start another project. And so it was as simple as saying, we know the markets we want to go to. We just need to physically go there. And it's different for me to go there and to see it and to feel it and to touch it and to imagine and to be creative thinking does a lot for me in the process. Whereas other people might be able to go to that market via a broker. But for me, I need to physically be out there, because it just, for my process, it really helps to physically be there as opposed to hear about it or look at it on Google Earth or look at a
So
listing.
we're going to come back to this idea of asset allocation and even some simple first steps for a business owner to start building those muscles of investing outside their business. But I want to come back to this idea. What's it like for you to be a money or a financial partner in a business? That's one that a lot of business people really don't think to do. And I've known enough people who've had that work really well and had it work really poorly, both. What for you has been the experience like, and what have been the 1 or 2 things that have been the most important lessons you've learned to make that make sense, right? In theory, it sounds perfect. I have a certain business experience, so I should know how to do the business, which means I should be a smarter investor in someone else doing the business. But the practical part of that is oftentimes, my choice of partner isn't the right way, or I don't have the experience of setting the expectations or how to manage my passive interest or something else. I've done that before and I've had good successes. I've done that before and I've had lawsuit and had to sue my partner for getting my money back out. I mean, it's the full gamut. I'm curious for you what you've taken from that experience.
Yeah, I think there's a whole book or books and books that talk about the right ways to structure them and what right legal agreements you need and all of that. And all of that is very important. It does matter. But for me, I think looking back over it and just having the experience of seeing some that have gone unbelievably well and some that have gone miserably awful, the difference for me has been the individual that's sponsoring the deal. Or maybe they're not the sponsor, maybe they are the operator of the business. And sometimes they're a partner, and sometimes they are just a really key employee. And either way, having that key person that really takes the ownership of the business and all the aspects of it, when that's going well, then we're just talking about business and we're growing the business and it's cash flowing and it does really well. And I thoroughly enjoy having monthly or quarterly meetings where I'm playing owner advisor instead of owner operator.
Yeah.
It's the ones where that key individual or principal or sponsor or whatever you want to call them, they don't really have the experience or the muscles or the strength or the experience in being that role and having that seat in the business. That's become the most challenging, because we're not even speaking the same language. And then all of a sudden you go from being owner advisor to, I feel like I'm owner operator now, and I'm
Owner
operating
babysitter.
Yeah, a babysitter. And so the real key is having the right person or people or team for whatever the business is.
Yeah. And I would agree with you. And some people are wired to do the role of operator if they're an employee, but something about them now feeling that they're an owner where, their compensation, their role is based off of the business itself being successful versus some of that guarantee. I've watched it lock good people up that had great integrity, but you put them in the ownership role and they just freeze and they're just not wired that way. And rather than trying to make them an owner, if I really wanted to do the business, I probably should just own the business and hire them with some kind of performance incentive with a guarantee of X or Y. And something about that seems to work. And I came to that one late in my career. I didn't learn that early on.
Yeah, and that's been one thing when I found the business opportunity and then went and found an individual and said, look at this great opportunity. You can come into it and run it, and this is going to be great. Those have seemed to not go as well. It goes better when that individual comes to me and says, I've got this great idea and I've got this opportunity. I just don't have the capital to do it.
And the warning sign is you can say, hey, this is the great opportunity. Here's what it would look like. And they start asking questions like, what's my salary going to be? And I'm like, whoa, 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 whoa. You know what your salary is going to be? Infinite, because you're going to work for someone else. You can't be my business partner. Anyone who asks me what's my salary going to be, they could be incredibly valuable as an employee, but they are not an owner. No owner says, what's my salary going to be in a new business opportunity? Because they know that it doesn't work that way.
That's right. That's right. That's a good one.
So coming back to the investments, I'm going to share a little bit for me that comes from the track of the business is my main economic engine and the asset that I'm really building. And I want you to come at it from the frame of how you've thought of your asset allocation across your real estate, because I think this is an important two different tracks of the same strategic decision making. So for me, when I look at it, my company, there was a time in a day that the company was probably 85% of my investable net worth, of my total net worth. Today, it represents probably about half, maybe 60%, but probably 50 to 60% of my total net worth is in the active businesses that I have. And the other is wealth outside of that. And what that's done is twofold. Number one, it makes the business less stressful because regardless of what happens in the business, I know my family and I were solved forever from the other part. And that wasn't always the case 20 years ago. So what let that happen? Some of the early steps with that part. Number one is as the business created revenue, I think one of the things that I did well that I would encourage is the use of simple tax advantage investing outside of that, right? The very least as a first step, as a coaching comment, do you have at minimum your IRAs, your SEP IRAs, possibly a 401k set up for your company, depending. That's a more complicated conversation, what the safe harbor for that is and so forth. But even just with an IRA, 401, and a SEP IRA, you're talking that if you're married, there's $100,000 or more right there that can be set aside as tax advantage. And, depending on the audience member's age, you're probably in most cases better to choose a Roth election for as much of that money as you're able to do. If you're 30, 40, even probably 50, I would choose the Roth election personally. I don't love the financial advice that says I should plan for the day that my income is less in retirement than it was when I was actively working. Why? Because I think if we do it the right way, my quote unquote retirement's not going to be a full retirement. I'm going to have interests in businesses and other investments, and I'll probably still make quite a bit of money from that other stuff anyways. And so if I can turn some of that Roth and just deal with my tax now, later on it's more valuable. That's my first step for those parts. That's where I got my start with that. And what to invest in, we can keep it really simple. I probably need to have some component of growth asset and some component of liquidity asset at minimum outside of the business. Liquidity lowers systemic risk. Liquidity, cash or cash equivalents, makes it where anything that goes on in the business or goes on in the investment side, I can handle it. And probably I want to have my growth assets spread between more than just one, but at the minimum, I need those two. And I'm going to probably have the majority in the growth side outside the company with some in liquidity. I talk to business owners, and the most common thing, Mark, that I see is not that they don't have enough cash on hand, is that they have too much cash on hand. I watch, people who will leave millions of dollars of excess working capital in their companies of clients of ours. And I'm like, look, we don't need you to be perfect with this, but it's risky to leave it sitting in the company. Let's look for intelligent ways outside of that you could invest that through. What does that look like? And I'll give one more coaching suggestion from it. Then I'll share my asset allocation, and then I'm going to ask you to take your best for your track where real estate's such a heavy part. Talk about how you've chosen to allocate and the percentages that you're aiming for. So for me, my last comment is, as a business owner, you're going to end up with excess cash. No question about it. If you're doing your business the way we've been talking about on this podcast or in the coaching program or these things, you're going to do that. But if your company does not need the capital to grow, and most businesses don't really require past a certain point more internal capital to grow, they don't. The capital needs to come out and get put to a more productive use. And I've chosen the route of, I don't really want to take an active management approach myself. So I've done a lot more passive choices wherein I'm buying index funds. Like if I look at my asset allocation for me, I'm going to look at, for me, roughly 8% is going to be cash or conservative cash equivalents, municipal funds, ETFs, or money market. That's my choice. That's a very high amount of cash to carry, or cash equivalents. Why? Helps me sleep at night. It speaks to that lizard part of my brain. If I were working with a client that had a business that was as consistently cash flowing as perhaps I do, I would probably tell them it's too high. However, it helps me sleep at night. And for me, I target 30% on the cash flowing real estate, commercial, where I can be a passive money partner in. And then for me, I do have an annuity component that I try to keep to under 5%. I've already paid the position. I did the calculation. It's about 11% right now of investable net worth outside the company. But each year that becomes a little bit less as I grow net worth. I don't need more annuity. It's basically brain dead money. That's why I have it there. If something happens to my brain or I get killed, my wife is going to be protected no matter what for the balance of her life. That's why I have it there. Different than life insurance, which we also have as well. And then the last component that for me is anywhere from 50 to 60% is the publicly traded equities. And I do that as ETF funds of index funds. I have some I put that between 4 different funds. Some are international, some are domestic with that. And for me, that's a simple way to go. It takes me probably 5 to 7 hours per quarter to intelligently manage that reasonably well. And that's continued to grow well, but my business is where the best of me economically goes. That's my view from that part. No right, no wrong. Mark, do the same kind of conversation in your track where the asset base really is heavily real estate because you've cultivated the advantages there. You are active in the roles that you're playing around that. And you've proven over time that you're quite good at it.
Yeah. So early on, my whole lens or way of looking at the financial part of our life was to think through cash flow. And so all I was looking for was, what can I go work on that creates cash flow and stack cash flows? And I would look at it and say, I've got this excess cash and I can go put it into the stock market and earn whatever, 8%. Or I can take it and put it in my own real estate deal and get 30 or 40 or 50% cash on cash. Like, who in their right mind would stick in the stock market? That'd just be silly. And so for years, it was just either buy or start a business or do real estate projects, because that's where I got so much more return, cash on cash, and could do it in a way that was responsibly leveraged and so forth. And then I got married and had kids. And so all of a sudden, I think what I'd preface all this conversation with is, it kind of matters what you're trying to achieve. We all have different values in our life. I have no desire to be a billionaire. It's not anywhere on the radar, but for some people, growing that empire is the thing that they're pursuing. I'm pursuing more freedom of time so I can spend it with my wife and my kids and my church and key relationships in our life and doing things outside the business. And so 2 or 3 years ago, I got to a place where I started doing asset allocation analysis. Before, I'd always done cash flow analysis to say my operating businesses they were like 80 or 90% of my cash flow, and my real estate was like, 10 or 20% of my cash flow. And as the years have gone by, the real estate, as debts have paid down and they've grown, it's become a much bigger portion of my cash flow, and my operating businesses, as we've sold them or reallocated them into real estate, has gotten a lot smaller. And but I never really looked at it from a standpoint of like net asset value or investable net worth is the word you're using. And so what's the net worth I have outside of my business that needs to be invested? Once I started looking at that, I realized my real estate was about 65 to 70% of my investable net worth. And operating businesses were maybe another 20%. And cash was basically all the rest. And I had give it 3 to 4% in stock market kind of things. And for a number of reasons, I started to look at it and say, you know what do I need to do to protect what's important to me, which is my family? If something were to happen to me and all of this stuff is put into real estate that maybe I'm an essential part of, that's not going to bode very well for my wife if something happens to me. And so we sat down and put together a plan to start reallocating our assets so that, one, I want to be more and more passive, which also accomplishes the goal of something happens to me, how's this more passive for my wife and for my kids? And so we started moving the needle. Today, I'm probably closer to 20 to 25% in the equities markets. Real estate is still a large portion. It'll probably always be in the 60+% range for us in the way that we do things, maybe 55. And then cash. So if I look at cash, we're cash, you might call it, cash in a checking account of maybe 5% of our investable net worth. And then we have a short-term investment account that's more like US Treasuries or indexes based around Treasuries or whatever, that it carries another percentage there, or 4 or 5%. And then the rest I've really tried to keep invested. And what I've noticed in doing that, back to my earlier conversation about asset allocation being important, what I've noticed is as I'm taking excess resources in the form of cash and putting it places where it's getting yield, I'm shocked by how much it's growing. And it's outpacing what I'm able to get up and go work for every day. And so I realized I need to spend more time understanding how to invest well, because as it grows and compounds, it's outpacing what it is that I'm able to perform. And so that was an eye opener to me that I wished I'd been doing it years earlier. But for us now, we have a kind of a schedule that says all of our entities have a certain cash target they keep. And after that, everything's distributed to the owners. And so we get our distribution of cash. We look at our lifestyle cost and try to keep that pretty minimal. And we pay ourselves that amount right away. We have charitable ambitions and giving ambitions. We pay that out right away. And then we have the excess. And of the excess, we take it and say, this much of it's going to go into real estate projects or debt pay downs. And this much of it, we're going to automatically and systematically put into the markets. And then once a quarter, if there's excess, we'll decide where it needs to go. But that's given us a way to have kind of a waterfall of cash flows where every month it happens automatic and systematic, and you don't just have things piling up and either not returning or being in a place that's not safe for it, frankly. And it's been super rewarding to have done that now for the last year and a half and started to see the real fruits from it.
I love hearing you say it that way, which I'm going to pull out 3 things that you said there. One was young Mark, let's build or buy a business, let's invest in real estate actively. Where else can I get the cash on cash returns and have these rates? That was the Mark pre-K, pre-kids, before you got married, before all the rest of it. And just this comment of the values drive the other. When I was younger, before Heather and I got married, I did have ambitions to build the billion-dollar companies. But that changed when I had kids for me too. I have no ambitions for that part of it. I want to have a wonderful life, and there is a point of enough really is. And so your second comment you said was cash flow versus allocation. Hey, I looked before at the cash flow a lot, but now I started looking at the growth and the allocation side. I really appreciated that. Like there was a time that you were 65 to 75% real estate, operating businesses around 20%, the rest maybe cash waiting to get placed somewhere, versus today, as you give the thinking that one of your values is to make sure your family's cared for forever, you could probably manage this stuff for another 20, 30, 40 years. You exercise and eat well and do your crossword puzzles and learn a foreign language and dance so your brain stays healthy and active. But just in case, I love that you've looked at that and said, how do we make this to protect should something happen to me? And I've had the same conversation with Heather. There, when we look at the assets, certainly the publicly traded equity side, she's not going to have to do anything with that. That's easy for
Right.
her. And the cash flow need is taken care of both from, you know, the dividends that kicks off and also the interest portion of the portfolio. You mentioned about the treasuries and having a portion in that. I think you said 4 or 5% in that, in whether it be directly in the treasuries or in index funds or funds of that part. For us, I'll add in there the annuity component, which is a small component, but it's forever. It's a peace of mind thing. I'm not looking for the return from it. I'm looking to make sure that no matter what, there's a monthly deposit amongst other things that takes care of any of the concerns. But I love what you had said there. Now you've made some adjustments. You're still 50, actually, I think you said 60+% real estate, but you're now 20, 25% on the equity side. These are all good, smart things, right? Your main operating businesses are real estate based. So to have some things outside of real estate based investments probably makes sense. And I know you're getting and gaining some geographic diversity, but also balancing off that if I get geographic balance in my portfolio, problem is it's hard to be an expert in markets that are 1,000 miles away. And I think you're
Yeah.
probably right for the way you're doing that. You're investing in the markets that you really do have local knowledge, and you've already protected yourself from the real estate through the other 40% of your net worth side, which is really smart. Last comment I have for you, or question I have for you, which is, how did you learn to get good at the real estate that you did? Give me a couple coaching suggestions. If I were a business owner watching or listening to this podcast, give me 2 coaching suggestions that could be a starting point for me to get better about real estate if I'm looking. Now, for a listener, I'm not suggesting personally that you go 60 or 70% of your portfolio unless you really have some real advantages. But probably it makes sense that 10% of your investable net worth over the long term or more is going to have some element of real estate. I talk to wealth advisors all the time. I've got clients who are wealth advisory firms. I don't know any of them that would say that you should ignore real estate completely. I also don't know any of them that should say that for most people, more than a certain proportion, they're going to kind of bring you down there, whether that be 50%, 60, 70%. Some point they're going to say, hey, let's scale this back and get some other lines of investment buckets going. But what 2 coaching suggestions, Mark, would you have for a business owner to start learning that?
I think the biggest thing is you've got to be interested in learning it. So anytime you're ignorant to something or you just don't have knowledge in that area, it seems scary, it seems risky, it doesn't seem like something you should do. But the more you begin to learn about it, the better. And so I started learning. I worked for a REIT right out of college, so I was learning every day. But even when I was there, I used to go to meetups in Orlando and went to conferences that I went to on my own that had nothing to do with the REIT, whether it was like Rich Dad Poor Dad kind of a conference or something like that,
Sure.
and just started learning. And then the other part was you have to start to put some money there to see how it goes. And so I just said, if I'm going to continue to learn about real estate, I'm going to invest in it and see how it goes. I think a huge part of it is understanding the numbers behind it. That's a big part, and it's not sophisticated at all. It's pretty basic revenue and expenses and understanding some of the terminology around cap rates and so forth. But real estate's also one of those things that's relatively, I shouldn't say it's easy, but it's very possible to invest in real estate without being a real estate guru or a real estate genius. There are some really, really good sponsors out there. I've invested in some apartments in Georgia, and I have nothing to do with them. I just get the report, I get my dividend. It's not going to yield nearly as much as my own projects do, but it gives me an exposure to apartment projects in Georgia that I don't have in Arkansas. So there's lots of ways to invest in real estate. And probably the place I would say I would lean into the most if I was a business owner would be the real estate that your business occupies.
Yeah.
People
Yeah.
overlook that all the time. My dad was a State Farm agent, still is. He's never owned his own building. He's in a 4 or 5 tenant strip in Oklahoma. And it's like, if you had just bought the building 20 years ago when they offered it to you, that would be worth several $1,000,000 now.
Yeah.
And there would have been nothing you had to do between now. You didn't even have to be a landlord, like just pay a management company. And so you've sat there and paid for it all these times over. And now you could step out of the business and still have the free cash flow from the real estate. But that would be the place I would look at, is to say, is there real estate revolving around what I'm already doing? And that's the easiest place to get into it. It's got the best financing options. It's got great tax advantages. It makes all the sense in the world. And then after that, you can kind of see if that keeps your appetite going for more.
I love that. So what I'm hearing, I'm going to pull four things from that. Number one, look at your own location. I will commonly tell people, if you're going to be in business for over a decade, 10 years or longer, in most cases, in most parts of the country, it probably makes sense to own. Certainly it makes sense to have the option to own the building that you're leasing. Why wouldn't you? Number two, that you said here, get curious, right? Make it a learning project, and you'll learn if you find it interesting or if you don't. If you don't find it interesting, you're probably not going to do it actively. The third thing that you said in there is that you're probably going to have to put some money on the table to learn something from that, right? Please, this should not be 15% of your net worth should not go to your first project. It might be 0.5% of your net worth or less. But when you have money on the table, you're going to learn something that you won't learn from just books and workshops and conferences. And then the fourth thing you said, there's a lot of different ways to do real estate, whether it's sponsor-led projects wherein you're investing money in someone else's project. Quickly, 3 quick coaching suggestions for any of our audience. Number one, look at the integrity and the competence of the person who's the main sponsor. Do a full-on background check on these people, right? Including litigation checks to see if they're involved with other lawsuits. Secondly, I personally would not invest in a sponsor who this is not their full-time business. I would also go one more, which is I want to invest in someone who's been through a downturn. Nowadays, I do most of my real estate through sponsors. And I've learned that if they have those 3 things, where I've done due diligence fairly well, this is their full-time gig over time, and they've been through a down cycle, they tend to be a much better bet than someone who's doing this part-time. It's early on. They have other things that distract them. This is new for them, and they've never been through a down market. I like to have the safety. And then the last kind of component is I can also, if I want real estate, but I don't want to do any of that, and I just want to do it the most brain-dead way, I could take 5% or 10% of my investable net worth and put it in an index of REIT funds. And I still would probably over 10 or 20 years come out just fine, as that is a moderating portion of my asset allocation. It's probably, for most business owners, a worthwhile thing to do if I'm not going to do any of the other things over the long haul. Comments back from you, Mark, on that?
Yeah, I mean, I think you hit on all the topics there. Having worked for a REIT, I might not invest in one, but
That's right. You've been in the sausage factory. You're thinking, man,
yeah,
if
that's
you met the
exactly
people
right.
I had met, David.
Yeah, haven't been in operating businesses, I wouldn't have one either. No. No, it's I mean, real estate for me, I absolutely love it. It's a place that I think I would, if I could do it all over again and start all over again, I probably would spend more time in residential real estate.
Yeah.
I say that, apartments
Yeah.
and rentals. I think we're becoming more and more of a renter nation. And I've got a residential property management company here, and we manage about 600 to 650 units. And for a chunk of that number is the professor at the college down the street, or the school teacher in town that works at the public schools, or a doctor, and they've got a rental or 2 or 4 or 5, and we do the management services for them. A lot of people make the mistake of thinking they should manage it for themselves because they'll save money. You're much better off to find a reputable group to do it and let them take on the headaches of being a landlord, and just do one house this year and maybe a duplex next year. And you'd be surprised over the course of time, like how far that goes and how eye-opening it is. I've seen too many people in our community that's been a big success story for them. And they're buying more and more, or now all of a sudden they've got a small apartment building. And real estate's a really powerful investment vehicle. And I'd highly recommend looking hard into it if you're not already.
Those are good final words of advice there. And again, what we've done is we put 2 parallel tracks, not that one is right or wrong than the other. They're just 2 different ones coming from 2 different starting points with that, heading toward probably similar values. I think what you're trying to accomplish with your family is very similar to what Heather and I are trying to do on our side.
Yeah.
But we've chosen 2 different tracks, but we both have agreed that we want to spread outside the business of assets. We want to choose a manageable allocation that's such that it's not so complicated. We're not going to invest in 35 different asset categories. how in the world would we ever be able to have advantages there? We both want to take into account that what happens if we're not there to manage it, this net worth, like for in your case, what could Kay do? In my case, what could Heather do? Or heaven forbid, if it's both of us gone or both of you gone with that part to make sure your kids and families are cared for. What last coaching comment would you have that you wish someone might have told you 20 years ago, but they didn't? But if you could go backwards in time and tell young Mark 20 years ago, what one coaching suggestion would you have given to yourself 20 years ago, Mark?
I think one of the things that's been, you mentioned investing in 35 different asset classes, and that would be crazy. I think I tried that. I was in various different industries, from oil and gas to restaurant to fitness facilities to real estate operating businesses to owning real estate portfolio. And I enjoyed learning about all those industries, but a big part of me looks at it now and says, if I had stayed a little bit more focused in asset class and developed more advantages there and seen those advantages continue to compound over time, maybe I'd have been better off for it. And maybe I'd have, more hair or less gray hair than I do now. And so today, that's one of the things I'm looking for, is staying more focused on what it is that I'm actively working to invest in. And in the places that I don't have advantages, buy the market. Just let the market return be good enough. I don't have to have a 33% cash on cash investment to go do. And so just buy the market and then focus a lot of your efforts, time, energy, learning activities in places that you feel like you have more advantages to or you enjoy, and go deeper there, because it's not just the financial compounding that takes place. It's the relational compounding. It's the network compounding. It's so many things that if left alone, compounding is really powerful. And so then the sooner you start, the better.
I love that. I think the coaching I would give to little David would be, hey, little David, relax. The money matters, but you know what? You're going to be just fine. I think when I look back 25, 30 years ago, when I was in my mid 20s to late 20s, early 30s, I locked into the scorecard of money and not seeing the broader picture of life. And I realize now the things I value most aren't the money. Now, granted, I can say that money is a sufficiency need. When you have enough, it becomes really less valuable. So I think for me, I would probably relax. And your comment about simplicity would probably be well-deserved. I would dabble in a lot less, and I would go deep in a few things I would just stay the course with over 20, 30, 40 years. And funny enough, do your business well, compound these other things, keep your life in perspective, stay married to the person you're with, not having to deal with the divorce and the financial. Forget the pain emotionally. I've got friends that have dealt with that, but the financial aftermath of the divorce, you're going to be just fine, right? And the things that matter. Mark, I want to say again, thank you on behalf of the community for you to spend 40 minutes with us on a subject that really matters. I think it's important for people to get multiple perspectives. Yes, we're heading toward the same direction, but it's okay that different people choose different paths. And quite frankly, we could have probably had another dozen people in the Maui community sharing their pathways, and both you and I would have been, oh, that's really interesting. I take things from that, but it's a different path than I would have chosen for those things. And on behalf of the community, I just want to say thank you for sharing the 45 minutes of the best of you with us. You're paying it forward to the community in a way I know you've received from it, but now you're really doing something special. I want to say thank you for you about that.
Thanks, David. Really enjoy being here. Always do. And I think I get more out of these than I bring to the table. So thanks for having me.
I feel the same way. So to all of our audience out there, you've done it. Another episode down under your belt. I hope you walk away with 1 or 2 practical, concrete, specific action steps that you're going to leave here with. And we'll see you next week on The Business Coach.